To understand the scale of a $1 trillion net worth, look at it in terms of time. If you spent $1 million every single day, it would take you more than 2,700 years to exhaust the fortune. At 9:30 a.m. on June 12, 2026, the SpaceX IPO technically makes Elon Musk the first trillionaire in history. But the financial ledger tells a conflicting story. SpaceX carries a $2 trillion valuation, despite recording a loss of over $4 billion in just the previous 3 months. In a traditional market, value follows performance. You look at revenue, profit margins, and production efficiency. Here, those metrics seem to have been replaced by something else entirely. This trillion-dollar milestone isn't fueled by the standard mechanics of profit and loss. Instead, it relies on a specific interplay between stock market psychology, a complex tax avoidance cycle, and a unique form of political leverage. Economists often refer to this as the castles in the air theory. It's a valuation model where the stock price isn't anchored to what the company is doing today, but to the psychological weight of the promises it makes for tomorrow. Take the 2013 Hyperloop announcement. It promised travel at 600 miles per hour, theoretically connecting Boston to New York in 30 minutes. By 2023, the primary company behind it vanished, having never moved a single commercial passenger. In 2017, the promise was a high-speed tunnel system to solve urban traffic. The actual result in Las Vegas was a 2-kilometer paved pipe, where Tesla cars still get stuck in standard traffic jams. The pattern repeats across every venture. Autonomous driving promised by 2017, 1 million robotaxis by 2020, and Mars settlements by 2024. These timelines pass, the goals shift, but the stock price remains buoyant. Investors aren't buying shares in a functional transport system or a colony on Mars. They are funding a financial narrative that multiplies the company's value based on things that do not yet exist. This creates a unique trap: paper wealth. Because Musk's fortune is tied to his shares, if he tried to sell them for cash, the market would likely panic, the price would drop, and his net worth would evaporate in real time. To get liquid cash without selling, billionaires use a cycle known as buy, borrow, die. They hold the shares to avoid capital gains taxes and use them as collateral to take out massive, low-interest loans from banks. We saw this in action during the Twitter acquisition. Musk didn't sell his Tesla shares. He mortgaged them to secure a $12.5 billion cash loan. He got the cash he needed while keeping the stock and avoiding the tax bill. This chart shows the disparity this creates. Between 2014 and 2018, Musk's wealth grew by nearly $14 billion, yet he paid an effective tax rate of just 3.2%, roughly 1/7 of what a typical working taxpayer contributes. The $1 salary isn't a sacrifice, it's a strategic choice to avoid standard income tax. As shown in the data, while a billionaire's paper wealth grows by billions, they often contribute a smaller percentage to public infrastructure than the people earning a standard paycheck. The final layer is political influence. After contributing $290 million to Donald Trump's 2024 campaign, Musk moved from donor to advisor, attending cabinet meetings and influencing federal appointments. This influence led to direct regulatory changes. For the SpaceX IPO, NASDAQ introduced a fast entry rule that bypassed the months of observation usually required to protect pension funds from overvalued new stocks. Favors followed in other sectors too. Favorable FCC rulings granted Starlink control over the majority of low Earth orbit satellites, while dozens of pending federal investigations into Musk's companies were dropped. Perhaps the most significant change occurred just 2 days before the IPO, when the SEC excused brokers from standard safety rules for SpaceX shares, removing the barrier that usually keeps customer savings separate from high-risk trades. By relaxing these safeguards, $70 billion in civilian savings and retirement funds were effectively moved into position to support Musk's trillion-dollar valuation. The narrative of the visionary genius obscures a simpler reality. This level of wealth is built on a foundation of delayed promises, tax loopholes, and heavy political lobbying. There is a massive global opportunity cost to this concentration of wealth. According to the World Food Program, a fraction of this paper fortune could save tens of millions of people from starvation. If the hype cycles fail and the castles in the air finally collapse, the billionaires will have already secured their loans. It is the average retail investor who will be left holding the debt. To avoid the crash, avoid the cult of personality. Don't look for shortcuts in a market where the rules are written for others. Instead, focus on the only asset that doesn't rely on hype.